I am personally concerned about the U.S. debt situation. It's not that the debt to GDP ratio at the moment is extraordinarily or worrisomely high, but it's also not very low. And it's projected, as the population continues to age and the baby boomers retire, that ratio will continue to rise in an unsustainable fashion. So the addition to the debt, taking what is already a significant problem and making it worse, is of concern to me. And I think it does suggest that in some future downturn, which could occur just for whatever reason, the amount of fiscal space that would exist for fiscal policy to play an active role it will be limited, may well be limited.
Also, Secretary Yellen, with the Treasury quickly approaching the debt limit, and I know that this is something which you've identified and have expressed concern over, it makes one question when America might become the next Greece. When, in your view, when do we have to say enough is enough when it comes to our deficit and our debt?
So one, in thinking about what is a reasonable level of debt, there are a number of different metrics that one might look at. Commonly, debt to GDP ratios are a measure that's widely used. Ours is a little bit over 100%, which traditionally has been regarded as high. But we are in a very low interest rate environment. That's been true for a very long time, and is likely to be true going forward. And an alternative, and I think better measure of fiscal sustainability is to look at the real net interest cost of the debt. What is it in real terms costing to service the outstanding debt? And for the last several years, that's been negative. And even if interest rates, 10-year rates and the Treasury yields revert in future years back up to more normal levels, the interest cost, which really is the burden, is projected to remain low. The plans that the Biden administration has put forth would keep that low at under 1% of GDP.
Oh my God. Oh, you're killing me.
All right, today is Thursday, September 30th. This is a recap for the stock market activities today. In focus tonight, we're going to talk about the debt crisis, the inflation crisis, and the fate of Fed Chairman Jerome Powell. We start with the debt crisis because while the Democrats appear to have a deal to avert a government shutdown and extend the funding all the way to December, we have yet to have a deal regarding the debt ceiling. We have the deadline, October 18th. If we don't have a deal, the United States of America will default on its debt. And of course, back in 2017, Janet Yellen said that the level of debt should keep Americans awake at night. Now, fast forward to today, where we have added almost $9 trillion to the debt from the level from 2017. But magically, Janet Yellen says that the level of debt is sustainable, and she weasels her way around, dancing around, making a fool out of herself, justifying that the level of debt right now is sustainable, and therefore we have to suspend the debt ceiling altogether. The debt to GDP ratio went to the stratosphere, but somehow today it is more sustainable than before in 2017. Folks, these people are irresponsible and incompetent, period. The problem is, if the U.S. defaults on its debt, it will be the biggest economic catastrophe, the biggest global disaster that the world has ever seen. So the assumption for now, the faith and hope that you beloved politicians will come to a deal to avert the crisis. But what if we're wrong in this assumption? And this is what the market is starting to feel right now because the divisions are so deep, even within the Democrats' party. For example, we have West Virginia Senator Manchin, who came out today and made his demands clear. The maximum he will allow is $1.5 trillion reconciliation bill. In his demand, Manchin says that the corporate tax rate should go up to 25%, while the top tax rate on income will be 39.6%, and capital gains taxes will go higher to 28%. But most importantly, he asks for the end of quantitative easing from the Fed, aka the end of the cocaine operation, which is not going to happen at all. So either this guy is bluffing and he's going to fall at some point, or we are heading to the May Day scenario of the United States of America defaulting on its debt for the first time ever. And by the way, even if he gets his wishes, whatever he is proposing right now is not going to be enough at all, because the budget deficit is now exceeding $3 trillion, meaning that taxes will have to go higher across the board. The question is, are they going to increase taxes on corporations? The most likely answer is no, because corporations own these politicians. The most likely scenario is they will increase taxes on average folks. For now, they continue to talk about the top earners. Meanwhile, the poor, middle class, they will not be touched at all. This is a lie. Your taxes will go higher. I'm willing to bet on it. 1,000,000%. Taxes will have to go higher across the board, including corporate taxes. So ask yourself a question once again. Is this bullish or bearish for the market? We continue to have experts on TV and those indulged, delusional retail traders and investors continuing to say buy the dip, the market will rebound, the market will recover, it's not a big deal. Well, number one, you're hitting corporate margins. What do you think that will do to stock prices when the margins go down? I know for now, stock prices don't care about fundamentals at all. The stock market cares about the Coke, but the Coke is coming to an abrupt end, which will catch the market and everybody by surprise. And that leads us to talk about inflation, because taxes will give corporate margins a haircut. Inflation will give another haircut. Again, do you think this is bullish for the stock market, or are you just delusional and out of your mind? But before we move on, here is the last comment from Jerome Powell, the Fed chairman, regarding the debt crisis and what happens if the United States of America defaults on its debt. Powell says no one should assume that the Fed could do much if there was a U.S. debt default. Powell says if the U.S. defaults, don't look to us for help. We got no tools left. We're done here. So if that happens, it will be the May Day scenario, not just for the market, but for the economy as a whole. And here's what's going on with the inflation crisis. Inflation is surging higher beyond expectations in every major region. The United States, the United Kingdom, and the EU. Inflation is surging higher, surpassing all expectations. And of course, central bankers are now caught by surprise. In the US, in the UK, in the EU, in Japan, everywhere, the cabal of central bankers all of a sudden realizes that they got it wrong. So when we said in this channel, fight the Fed, it is time to fight the Fed, because the Fed and central bankers are not always right. And you're seeing this in real time. Central bankers all of a sudden are saying, oh, we didn't see this one coming. We didn't know inflation would get out of hand. Meanwhile, a guy on YouTube figured this out months ago. How did that happen? I don't have a degree from Harvard. I don't have a degree from Wharton. I don't have a degree from Yale. But somehow I figured this out while the Yales and Harvards of the world, all these central bankers, Goldman Sachs graduates, got it wrong. Surprise, surprise. Now, what happens when inflation rises higher, out of control, out of whack, while growth, economic growth, slows down? Then we have the phenomenon of stagflation, the worst economic scenario ever. And the last time we saw that scenario was back in the late 70s. We're heading into that direction now because we have a slowdown in the global economy. The entire global economy is slowing down while inflation is rising higher globally. We have the biggest potential stagflation crisis in history, because this time around, it is way bigger than the 70s. The level of debt, the rise in inflation in commodities, which was limited to oil prices in the 70s, Now it's not limited to oil. We have inflation across the board, from shelter to food to shipping prices to the labor shortage. This is the perfect storm of perhaps the greatest inflation crisis in our lifetime. And today we got another warning from China. The manufacturing PMI was stunning. Prices went higher. Economic activities went down to negative territory. Once again, the second largest economy in the world is now suffering from stagflation. We also got the Chicago PMI, and while the headline number is down, backlogs are down, deliveries are down, even prices are down. One would say that perhaps the economy is slowing down and there is no problem here. No inflation, it's okay. But here is the question of the month in this survey. And the question reads, as prices pick up nationwide, are your staff costs likely to increase in the next 6 months? The majority of respondents said that they would, by 0 to 5%. And the second question was, now that the Delta variant has become an area of back to work delay, has your company modified its supply chain strategy to address potential problems in manufacturing and other problems, I guess? It's not worded correctly here, but the majority responded that they had. They're changing their plans. They're changing their strategy here. And the majority of the change is increasing prices to the end customer. And perhaps the front and center of this inflation crisis right now is natural gas. All eyes on natural gas. And notice how we shift from one commodity to the other. It started, for example, with lumber, then we went to coffee, then to oil, then to natural gas, and now cotton prices are exploding higher. And it's going to go on and on and on with no stop in sight at all. Notice where grains prices, food prices are surging higher. Why is this happening? The reason is when you have reckless monetary policy globally, printing money out of thin air, flooding the system with unneeded liquidity, this liquidity will have to go and chase assets, from the equities market to real estate to commodities. And now that we're reaching the stagflation stage, we have bloated valuations already in the equities and real estate markets, this money is chasing commodities, and the natural gas prices cannot come at a worse time. The biggest rally in U.S. natural gas futures since the beginning of the century has some traders betting that prices will spike to an unheard of $40 per million BTUs. Once again, $40 per million BTUs. This will smash the economy down to its knees. You are already hearing about the problem over at the United Kingdom due to the shortage in petrol, but more specifically the shortage of truckers to drive the petrol to gas stations. For now, the problem is alleviating. Keyword for now, but mark my words, it will get worse. This is just the beginning. On top of the reckless policy from the Fed and other central bankers. Added to that, the COVID-19 crisis of shutdowns and lockdowns and labor shortage, port slowdowns, etc. We have weird weather phenomenons, the climate change, reducing crops across the globe. We also have diseases in cows and pork. Now add to that the fact that all of these commodities, the US dollar, were heavily shorted. And now that we're shifting regimes from the easy monetary policy to a tightening monetary policy, a lot of these shorts are getting caught with their pants down, and they're covering in natural gas, in cotton, in crude oil, in the US dollar, and therefore we're seeing these exaggerated moves higher, and we are just seeing the beginning of the short covering storm. You and I are also aware about the crisis that's going on in the ports, specifically in the LA Long Beach port, with the logjam. And to alleviate the crisis, they tried to recruit truckers, and they offered decent incentives. But guess what? Truckers did not show up. A pilot program offering 24-hour container operations at the port of Long Beach has not attracted any truckers more than 2 weeks since the extended hours began. So once again, this is going to get worse and worse and worse. I used to be a trucker before. There is no way I would do the job again unless you pay at least a minimum $250,000 minimum. Then maybe I'm interested. Therefore, you're going to see this problem getting worse and worse and worse, not just in the US, but in the EU and Asian countries. And now with inflation raging out of control, even safe assets are going to start to lose value. The US could be heading into an era of high inflation that produces paltry or even negative real returns on safe assets. Even solar companies are now asking customers, please stop ordering. We cannot fill your orders. We will not be able to fill your orders. We have shortages across the supply chain. It is impossible to fulfill your orders. And we have delays now. Even the iPhone 13 is getting delayed, by the way. So this is becoming a massive problem for the markets and for the economy. And you're already seeing what's going on with Dollar Tree raising prices. Soon enough, the 99-cent store will be the 99 bucks store. And now we have Bed Bath & Beyond. Shares were down over 20% today. Shares of Bed Bath & Beyond fell nearly 30% after the retailer slashed its forecasts for the year, blaming supply chain hurdles and rising cases of the fast-spreading Delta variant of the coronavirus. And we know this will not be the last variant, by the way. We're going to have more variants to come. The variants will magically disappear when everybody gets the holy jab. Even though we're still going to have variants, so people are going to die, but the media will stop talking about it, and then poof, it goes away once they get the thing inside your body. The rally in Bed Bath & Beyond, which by the way participated in the meme stock frenzy, look at where it's trading right now, back to where it started the year. If you bought Bed Bath & Beyond because you decided to YOLO stocks with your life savings, you are now holding a massive bag. And this is a warning for the retail crowd, the apes and the likes, who are YOLOing stocks in GME, AMC, and now Dole. The apes are YOLOing Dole. These people are just begging to get slaughtered. And they should be slaughtered, frankly. And they will be slaughtered 100%. Think about it. You have this generation of young investors who are YOLOing stocks, almost bankrupt companies, in the hope of a short squeeze. You go to Wall Street Bets. They post the screenshots of their losses. Certain traders lost 100%, losing thousands of dollars, if not hundreds of thousands of dollars. All of this money could have paid for college, could have bought you a decent home, could have been saved for a rainy day, or even allocated for a more sound investment than YOLOing stocks, meme stocks, that is. When you think about it, all of these people suffering in other countries in Africa and the likes. Meanwhile, we have a generation of investors, of young people, who have no problem losing hundreds of thousands of dollars, posting the screenshot over at Wall Street Bets and bragging about their losses. They're laughing. These are not good people. They're probably going to grow up to become Wall Street executives, and they're going to start YOLOing stocks with other people's money. Just give them time. They will figure it out. They will learn how to become the predator. We heard from another company in the morning, CarMax, which is one of my picks in the inflation trade, but even CarMax could not handle this level of inflation. The revenue was good, but the margins are getting squeezed now. Between the labor shortage, wage inflation, and the rise of used car prices, they have to buy them expensive now and sell them even more expensive. But this is killing their margins. Inflation is good in the beginning, but now we're morphing into stagflation. When we go to stagflation, even inflationary companies and inflationary stocks suffer. There are pretty much a handful of stocks that could withstand the storm of stagflation. But even with that, there are no guarantees. Why? Due to the ETFization of the market, meaning that even if you have good stocks, they will go down due to crashes in the big cap technology stocks and other heavyweight stocks. This is the disease of ETFs, of lumping the good, the bad, and the ugly all together. And the market will pay the price. Everybody has been cheerleading the ETFization of the market, but in the next crash, you will regret that even your good stocks are now lumped in ETFs with names that are going to go down, and therefore they're going to drag everything down with them. We had another warning in the morning from Kohl's, a retailer. The stock crashed because the inflation is too much to handle here. Of course, if companies like Kohl's go down, the last survivors in the retail arena, who's going to pick up the spoils, by the way? The answer is Amazon. Folks, this whole pandemic, since the beginning, has been the biggest transfer of wealth operation in the history of humanity. From the little guy to the big guy. The biggest concentration of wealth in the history of humanity. And now even mortgage rates are rising higher. In this hypermania, hyper-bubble housing market, what do you think will happen if mortgage rates continue to rise higher? The entire bubble will come down crashing, and pay attention here. Powell says my test for raising interest rates, the substantial further progress, is more stringent. We're not going to raise interest rates until we have 1 trillion jobs open and inflation has reached 10,000%. Here's the problem. The market will do the tightening for Powell, meaning you're going to see massive bond dumping. Yields will spike up higher to 2, 2.5%, 3%, predicting that the Fed will be forced to raise interest rates abruptly. Watch how yields react. If yields continue to rise higher in an insane fashion, then you'll know right away the bond market will do the tightening for the Fed. This will be a dire scenario. And by the way, what is Powell saying about all of this? Powell says inflation is quote-unquote frustrating, or you think, and see it running into next year. What happened to transitory, Powell? I thought it's going to be transitory, or we shouldn't worry about it. Now he says it's going to run into next year. So what is transitory? I think that the Fed chairman owe us an explanation, owe us a definition. What is transitory? Give us a time frame and give us a formula on how you're going to average inflation to 2%. We cannot have this madman running loose, letting inflation rage across the globe while he's not using even a formula, while he's not even defining what transitory is. Powell says factors pushing inflation higher could last until next summer or next fall or next winter or 2023, 2024, 2025, because what is transitory? Life is transitory, right? But don't have any hope that this madman will realize what's going on here. Fed Reserve Chair defends low interest rate policies, says inflation will remain high. Perhaps this is the goal, by the way. Perhaps this is their goal, the end goal, to create this massive inflation crisis, to transfer the wealth from the poor to the rich, create massive starvation, all at the cost to make the rich richer, to make sure that the stock and real estate markets are protected and inflated. The problem is, it is firing back and even the stock market is starting to crash. The problem is, the market will crash on the heads of the retail crowd. Meanwhile, the Wall Streeters and the likes already booked profits, Fed presidents already out, corporate executives already out, cashed in billions and billions of dollars. Chamath is out. You and I are going to be left holding the bag here. And today we heard from other central bankers from the Czech Republic and Russia. And in both countries, they hiked interest rates higher because inflation is raging out of control. Matter of fact, the central bank over the Czech Republic initiated the biggest rate hike in 24 years. The problem is, even if these countries continue to hike rates, so long as the central bank of the world, the Federal Reserve, continues to keep rates suppressed, inflation will continue to rise higher and rage out of control, even if these countries hike their rates higher, because everything is dollarized. But the point illustrated here is we have central bankers across the world responding to the problem by hiking rates higher. The central bank of the world continues to be ignorant, continues to be obtuse, continues to be in denial, and this will not only cost the United States, but will cost the entire global economy a dire cost. Lastly, let's talk about this man, Jerome Powell, Mr. Dangerous. With this inflation crisis raging out of control, and now we have the debt crisis, the Biden administration will suffer a tremendous cost. A political cost, of course. They will need to shift the blame to another boogeyman. And who's available for that blame? The answer is Jerome Powell, the donkey that he is. To begin with, he's a Republican. They're going to blame him as a Republican, a Trump appointee who was reckless, with a hot hand on the printer machine. He's the one to blame for inflation, not the Biden administration or the Biden policies. So the Biden administration will throw Jerome Powell under the bus, and Wall Street will have no choice but to go with the plan. Wall Street will have to sacrifice Jerome Powell, because when you think about it, they have a million Powell. They can appoint Brain Dead, they can appoint Boystick, they can appoint Harker, or any Fed zombie, and they will do the same job as Jerome Powell. This is what Powell did not anticipate. He thought if he continues to please Wall Street, the stock market will finish up the year higher. Wall Street will be pleased, and they will pressure the Biden administration to renew his tenure. But this is all firing back, and they will throw Jerome Powell and sacrifice him like the lamb he is. You see, we criticize Powell in the program as reckless and irresponsible and perhaps criminal. But the truth is, Powell is just a button man. He gets his orders from Wall Street. He gets his orders from the ruling class. And the ruling class will sacrifice Powell before Biden because Powell is replaceable. Biden is not. If the Biden administration fails, the replacement, at least for now, will be going back to Trump. They don't want to go there. And therefore, say goodbye to Jerome Powell, because absent of America, this man is done. He's toast. He's not coming back. The end of Jerome Powell, the most reckless, irresponsible, and perhaps the dumbest Fed chairman ever. And with that, ladies and gentlemen, we're moving on to the markets coverage today. And here we go. The Dow Industrial Average is down 546.80 points, or a decline of 1.59%. The Nasdaq is down 63.86 points, or a decline of 0.44%. The S&P 500 is down 51.92%, that would be wild, 51.92 points, or a decline of 1.19%. Down 51.92% will be bear porn. What about the sector's performance today? Leading the pack at number one? Oh, wait a minute. They're all down. Awful picture across the board, and the losses are led by defensives, industrials, and REITs. Notice, for example, yesterday, the defensives, utilities, and REITs outperformed, but I told you this is not sustainable at all. The market will not bottom, listen to me now, the market will not bottom until yields and the dollar top. I repeat, the market will not bottom until both yields and the dollar top. What about the advance to decline ratios? NYSE 28% advancing versus 69% declining. The Nasdaq 46% advancing versus 50% declining. Moving on to futures, what's going on here? Gains across the board. The dollar went down slightly today because we have seen a recovery in the sterling, the New Zealand kiwi, even the yen, and therefore the dollar is down slightly. And this was good enough for a rally in metals and other commodities. But perhaps the most relentless rally I've seen so far is in crude oil. And I haven't seen a relentless rally in crude oil since the 2007 rally. Because even though the dollar has been rallying higher, exploding higher, crude oil continued to rise higher and higher and higher. And today we got the news that the inventories are way higher than expectations. And this was bad for crude oil prices. And they went down, but they recovered regardless by the end of the day. What does that say? By the way, I don't believe the data that all of a sudden we have this massive inventory. I believe that they're cooking the data to control the rise in crude oil prices. But anyhow, the fact that crude oil prices did a 180 and closed in the green, that tells you that we have massive conviction here that crude oil prices will go all the way to 100. They want it to go there, and they will get it there so long as they continue to buy the dips over and over and over again. But the story here is in natural gas up almost 10% today, a massive rally. Once again, just when you thought the rally in natural gas is stopping, think again, because the catalysts, the positive catalysts are all here. They're all lined up. From Hurricane Ida, the damage to the infrastructure of natural gas, to the upcoming demand in the winter season. And on top of that, we have massive short covering. They've been shorting natural gas for years, and now they got caught with their pants down. What about softs? Even lumber is rallying, by the way. Watch out here for the short squeeze in lumber, the transitory commodity. By the way, lumber is rising higher by more than 4%. We also have gains for cotton futures exploding higher. No stop in sight here. I thought 100 will be the target for traders, but this is a massive, epic short squeeze, and the prices of your apparel will go higher. Likewise, we have a rally in sugar, cocoa, and a modest one for coffee futures. The decliner of the day, OJ futures, down over 2% today. What about metals? Good day for metals. Gold higher, silver, platinum, palladium. The only absence today is coming from Dr. Copper, down over 2%. The problem here with copper is the Chinese demand. We got the Chinese PMI, the economy is in stagflation, the demand is pretty much getting wiped out here, and therefore copper is down. What about meats? We have declines of 1% apiece for live and feeder cattle futures. Meanwhile, another day with more gains for the new big tech, lean hogs. Almost 2% rally today. What about grains? We have losses here for soybeans, soybean meal, corn, oats, and rough rice. Meanwhile, a rally for wheat and soybean oil futures. I'm in lean hogs and soybean oil for now. I do believe that soybean oil futures bottomed, and we're about to see a rally from this point on. Moving on to the big casino, the options market. What's going on here? At number one, not Apple. Once again, it is Tesla, the souffle, with about 1 million contracts. But this time around, listen to this, 60% of those are puts. And I do believe that the sentiment will change here in Tesla. Whoever that whale is who've been manipulating the stock higher, they will perhaps stop now that the rats are jumping the ship. Of course, they've been pumping in anticipation of the new delivery numbers. And of course, we know that Reverend Elon and Tesla have been lying about the delivery numbers. There is no way you can verify what the delivery numbers are. because Tesla has a problem with transparency. It's the only automobile company, by the way, that doesn't release the geographical breakdown of their sales. Why? Because if we have that number, we can verify. Every other car manufacturer provide us with those numbers, with the exception of Tesla. So whatever number they put out there, it's by the rumor, sell the news. And here it is at number 2, AMC, a planned rallying today, over 7%, a surprise rally midday, with over 1 million contracts, almost. About 68% of those were calls. Of course, AMC was down big in the morning, but suddenly midday we saw a U-turn 180, and AMC was rallying higher. Now, I've heard many theories here. Some people are attributing the rally to news regarding Citadel. Others are attributing the rally to news from AMC CEO Adam Aron, who announced that the company is buying back its debt, about $35 million. Regardless of what the piece of news is, my answer is somebody bought an enormous amount of options today, call options, with the expiration date tomorrow. And this was the catalyst for the stock to rally higher. They have initiated a surprise gamma squeeze midday with the expiration date of tomorrow. What does that say? It tells me that we have a massive whale here who've been holding the bag in these call options. And they have initiated a rescue operation here by buying the $40 calls. As you can see here, about 63,000 of those were traded today, and we have about 16,000 in open interest. So massive buying here, specifically for the 40. Here's the problem though. Is this the catalyst that the apes needed to rescue the price? Meaning, is this going to be a sustainable build-up of a rally, of another gamma squeeze, perhaps a short squeeze, or preferably a combination of both? Or is this just an operation from one large whale who's pumping these call options and they will intend to dump them tomorrow, if they didn't dump them already? We will know the answer by tomorrow. But here it is at number 3, Apple, with about 830,000 contracts. About 62% of those were calls. Moving on to the unusual activities that took place in the options market today, starting with the ticker EFA. This is a European ETF. They bought calls here, the 83 calls, for the expiration date November 19th, with expectations that the name will pop higher by more than 6.5% by then. They paid about 20 cents apiece to enter this trade. All in all, spending about $1 million. What about the ticker ATUS? This is for a company called Altice. This is a cable company that have been hammered in the last few weeks, but today we have seen a rebound, perhaps a short covering rally, and they're betting for more gains to come here by buying the 22 calls with the expiration date November 19th, with expectations that the name will pop higher by more than 6% by then. They paid about $1.40 apiece to enter this trade. All in all, spending about $1.3 million. What about the ticker VRRM for Vera Mobility? This is a company that processes video cam footage from traffic lights and parking tickets, etc., etc. They're betting for gains to come here by buying the 17.5 calls with the expiration date November 19th, with expectations that the name will pop higher by more than 16% or so. They paid about 30 cents apiece to enter this trade. All in all, spending about $250,000. What about the ticker VLTA? This is for a company called Volta, an EV charging company, and they're also betting for more gains to come, even though the stock had a massive down day of about 23% or so. Massive losses, but somebody's betting for a rebound here by buying the $10 calls with the expiration date November 19th, with expectations that the name will pop higher, or rebound higher, shall we say, by about 15.5% or more. They paid about 80 cents apiece to enter this trade. All in all, spending about $680,000. What about the trade for the ticker UNG, natural gas? They're betting for more gains to come here, folks. They're buying the 22 calls with the expiration date October 8th, with expectations that the name will pop higher by more than 9%. They paid about 60 cents apiece to enter this trade. All in all, spending about $350,000. What about the trade for the ticker XHB? This is for the Home Builders ETF. Now, the premium spread in this name is extremely wide, and therefore, if you want to short or bet for home builders, just pick an individual name. D.R. Horton, Lennar, Toll Brothers, doesn't matter to me. They all trade together. But somebody's betting here for a massive whack in the head coming for the home builders. And by the way, this is a proxy trade betting that yields and interest rates will surge higher. If interest rates go higher, then these home builders suffer. They bought the 64 puts with the expiration date November 19th, with expectations that the name will drop down by by more than 11% by then. They paid about $1.50 apiece to enter this trade. All in all, spending about $500,000. What about the trades for the ticker XLE, the energy ETF? They continue to buy these call spreads in the XLE XOP over and over and over again. The rally in oil is extremely relentless here. They bought the 56 calls and they sold the 59. The expiration date for November 12th. They paid about $1 a piece for the 56 calls and they received about 50 cents a piece for the 59 calls they sold. All in all, the entry cost for this trade is about 50 cents, and therefore they spent about $250,000 on this trade. What about the trade for the ticker CTVA, Corteva? This is one of my favorite companies, and I hold calls, by the way, with the expiration date of next year, and I am holding the bag here because I bought these earlier this year, and the stock did not move higher, but it remains one of my favorite names. It's in the agricultural business, and we know that grains prices will continue to rise higher, and the demand for Corteva products will also surge higher. Somebody's betting for more gains to come here by buying the 46 calls with the expiration date November 19th. With expectations that the name will pop higher by more than 10% or so by then, they paid about 70 cents apiece to enter this trade. All in all, spending about $300,000. Lastly, what about the trade for the ticker XOP, another oil ETF? This time around, they're betting for declines, perhaps calling the top. They bought the 87.5 puts with the expiration date October 29th, with expectations that the XOP will go down by more than 9.5% by then. They paid about $2 a piece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis. Anything to see here? Of course not. Everything is down. Nothing is working. Not the inflationary trade, not the tech trade, not the defensive trade. Nothing is working. The only thing that is working are names related to options market activities. And I watch the options market like a hawk. I know what's going on here with names like Snapchat, AMD. These are all popping higher due to call options buying, creating mini gamma squeezes. For example, we covered the trade from Moderna last night, and of course, Moderna is popping higher because we have seen some call options buying betting on a rebound. The problem is these rallies are not sustainable. They're going to rally for a day or two, and then they're going to pop and trade along with the market. For example, you have Netflix. Netflix has been rallying over and over and over again because we have massive call options buying activities. The problem is, how do you know that the rally in Netflix is sustainable? Because, unfortunately, if the big cap technology names fall apart, they will drag Netflix down with them. For now, the pain in big cap technology stocks is contained. Apple is down about 1%, Microsoft about 1%, Amazon, Google about 0.5% apiece, Facebook barely on the flat line, and therefore the market is holding for now. But if these big caps start to fall apart, the entire market will fall. And frankly speaking, I would love to get that out of the way. Just crash them already. Let's get the massive crash, the massive correction. 10, 15, 20%, and let's get it out of the way. Wash all of this hyper bullish sentiment out of the market, and then when everybody's scared, everybody's shitting their pants, we're gonna have a buying opportunity. But before we do that, we have to get rid of the items in the wall of worry too. You cannot just have a tradable bottom and call that sustainable. You gotta solve these problems: the debt crisis, the inflation crisis, the risk from China, etc., etc., etc. Things will get better, but they have to get worse first. Moving on to the charts analysis, starting with the SPY 30 minutes chart. What's going on here? The bear flag is playing out, and now the support of 430 is broken. I will give the market the benefit of the doubt by calling the last bottom at around 428.86 cents. Let's see if the market can rebound from this point on. The double bottom scenario. We'll see if that happens on Friday, meaning tomorrow. And by the way, as it happens every first day of the month, we have a rally. This is the trend, the pattern, not the rule. The resistance remains at 434. This level been holding and holding and holding, and therefore expect this level to be extremely strong as a resistance. And by the way, what happens if the double bottom fails? The answer is we go down all the way. We have soft support at around 422. This will be a lot of pain if the market flushes down. What about the daily chart for the continuous contract on the SPY? It is now becoming evident that we have a reverse ABC pattern, which is likely to take the SPY down to 4,232. I believe we will find a bottom there. The market will be oversold and we will have at least a tradable bottom. Look at the MACD indicator, look at the RSI, they're all trading down. They're all falling down, nose diving, indicating that the strength is in the negative momentum. But we're also heading closer to the oversold territory. On the other hand, we have the volume continuing to spike up higher on down days. That tells me that the institutionals are not buying the dip here. They're just selling on selling days. They're getting rid of stocks. They're doing some profit taking here and there. What about the Qs? The NASDAQ, not looking good here, flushing down, violating the support of 360 and a half, even 360 if you want to play that number. It was broken today, and therefore it becomes the resistance. Where is the next support, by the way? The next support is all the way down at 352, but that would be a soft support point. And again, this chart means nothing at all. The chart you should be paying attention to is the chart of the 10-year yield. Once the 10-year yield tops, then we have a tradable bottom in the NASDAQ. Moving on, the daily chart with the continuous contract on the NASDAQ. Head and shoulder formation playing out. The momentum is accelerating to the downside. The volume is rising higher on down days. And now we have 3-4 candles, down candles in a row. Absent of a rescue scenario, the chart will go down to my target of 14,000. By the way, here's a chart of the NDX, the big NASDAQ. We have a trend line that goes back all the way to last September, almost a year ago. Every time we had a divergence from the trend line, the chart corrected down all the way to the trend line. And we have seen drops ranging from 14% all the way down to 8%. For now, if the market goes down following the pattern to re-tag the trend line, then the correction is expected to go down all the way to the trend line, and this will be top to bottom, a correction of about 9% or so, which is, by the way, normal and pretty usual. There's nothing unusual about a correction of 9 to 10% mid-year. By the way, this is the top of the dot-com bubble. The chart respects the trend line. It might violate the trend line once in a while, and these are bear traps because the rebound and the recapture of the trend line happens quickly, within days. The dips are bought, we're back at the trend line. The ultimate break happened when the trend was broken, and here comes the attempt to recapture the trend line, and that was met with failure. Right there and then, you knew right away, it's over. And by the way, we had a semi-head and shoulder formation too on top of that. And perhaps this is exactly what we're seeing in the market right now. The failure to recapture the trend line. What does that tell us? Perhaps we have the top. And here's a chart of the IWM flushing down. And again, I gotta see how it reacts around 218. If 218 holds, then we might have a tradable bottom, buying call options with the target of about 223. So you're gonna buy calls for the 220, in, out, hello, goodbye. What about the Dixie? Most important chart to watch here. Popping higher, but today pushed on the brakes. Do we have a top? The answer is not clear. On one hand, the RSI is on overbought conditions, meaning that we're getting closer and closer to the top. Likewise, the MACD indicator remains extremely strong here, but we're getting extended. Not a top, we are getting extended here. The only reason that I say you gotta be careful in calling a top in the Dixie because we're having massive short covering here. There were a lot of traders and investors betting against the dollar, and now they're getting caught with their pants down, with the tapering and tightening. And therefore, you gotta wait for the confirmation of the top before you conduct your trades accordingly. For me, I gotta wait for 94.7 or a confirmation from a candlestick pattern. A follow-up, another red candle, perhaps violating the support of 93.7. Then I'll be comfortable that we have a top in the dollar, and therefore you go back to metals, the inflationary trade, etc. Moving on to gold, what's going on here? Popping higher, but stopping at the resistance of the Fibonacci levels. I'm not buying it. I don't see a rally in gold as sustainable unless we have a top in the Dixie and yields. Absent of that, forget about gold. And here it is, the chart of the 10-year yield. Do we have a top? Is this it? For now at least, who knows? We're getting extended, but the likelihood is we're gonna pop higher again because whatever message the bond market is sending, they want to close it above 1.5% for the week. This will solidify the message that this is a change in sentiment, not just a pop, not just a trading opportunity, but it is sustainable. Of course, we will reach the ultimate destination of 2% by the end of the year. This is the bet for now. The likelihood is you're not going to see a vertical rally. one shot up all the way to 2%. You're going to have drops. The likelihood is we will see an ABC pattern here. Are we seeing the B leg? And how far down will the B leg go, which is, by the way, will be followed by the C leg, which will take us higher. My assumption is if this is the beginning of the B leg, then yields will go down to 1.4 and then rebound higher. But I find it hard to believe that after all of this work, they're going to close the week under 1.5%. And here's the chart for the TLT weekly chart. We have negative divergence. We almost have a negative crossing in the MACD indicator, and the candlestick pattern doesn't look good at all. The most likely outcome is the chart will go down to 134.5. What about the VIX? Extremely important chart to watch. This is the 4 hours chart. I don't care about the candlesticks at all. All I care about is the MACD indicator and the 20 level. For now, the VIX is trading above 20, and it is trading in positive territory on the MACD indicator. Yes, the green columns are getting shorter and shorter and shorter, perhaps indicating the beginning of the end of the pop. But by the end of the day, the VIX surged higher again, and the columns started to get longer and longer. Perhaps this is an indicator that we are not done with the pop in the VIX. And if we're not done with the pop in the VIX, then we're not done with the dump in the SPY. Perhaps another flush down, a massive down day in the SPY, a massive pop higher in the VIX. That'll do it. But we're also watching for Kill the VIX Fridays. Are they going to be back? Or is the VIX going to crush the bulls again and close above 20? This is important because the battle of sentiment is telling. The bulls were extremely confident a few weeks ago, buying the dips, crushing the VIX Fridays. But as of late, the bears have been gaining a lot of advantage, a lot of tactical advantage. If they close the VIX above 20 again on a Friday and the first day of the month, it will be a massive victory for the bears. What about Apple? What's going on here? The bear flag is playing out. Again, nothing to see here. The destination is all the way down to the end of the channel, which will be 15% top to bottom. The problem is, if we continue to go down after that, then we have a massive problem in the market, and therefore, the chart of Apple is extremely important to watch. Apple is the market, and the market is Apple. And what about Tesla, the souffle? What's going on here? We had a triangle consolidation here, and my bet was we will pop higher based on the primary move. The pole of the flag, the triangle, whatever you want to call it, doesn't matter to me. But watch out here, when the bear turns bullish, it is probably a contrarian indicator that the souffle is about to get crushed. And of course, when you get the news that Mama Kathy's dumping and Chamath dumped already, and who knows who else is going to dump now. It is a massive change in sentiment here, and it is extremely important because a lot of wise traders who rode the souffle higher, they will say, okay, let's do the math here. Number one, the competition is rising higher and higher and higher. Number two, commodity prices are rising higher and higher and higher, meaning that the margins for Tesla are not going to be good. They're going to continue to raise prices, and therefore this will cost them market share. On top of that, we have extreme overvaluations, and now we know that we have the pumpers. They're dumping now. So the pros among the retail traders and investors community will start to book profits. The hardcore believers, the culties and the likes, they're the one who are going to end up holding the bag because they're anticipating this delivery number. They're buying the rumor, and we know we have buy the rumor, sell the news. With all of these indicators that we have, the chip shortage, we have Toyota cutting numbers, we have Ford cutting numbers, GM cutting numbers, the Chinese EV manufacturers cutting numbers, we have Hyundai cutting numbers, Nissan cutting numbers, and all of a sudden magically Tesla will have good numbers. I know Reverend Elon said that we're not going to have any chip problem here, but you cannot trust anything this man says. He's a pathological liar, and therefore if you're betting right now that Tesla will go higher based on that number, watch out. You could be facing buy the rumor, sell the news. I see the exit of Chamath as a major shift in the story here of the rise and the upcoming fall of Tesla's stock. Again, we're talking about the stock, not the company. Two different things. Moving on to tulips, BTC, what's going on here? Popping higher, still holding the battle and the retest of 42,000. It's in a bear flag consolidation. The likelihood is if you continue to consolidate over and over and over again, it is just a matter of time before the bear flag materializes and BTC goes down. We have some strength right now in the MACD and RSI indicators. This is the daily, of course. We might have a crossing. BTC might pop a little higher, but the real test will be the upper end of the breakdown candle, which is around 47,359. The problem with BTC see is the weekly chart is extremely weak. You guys got to pay attention to the weekly chart. Maybe if you're trading this thing day to day, you want to buy here, anticipating a pop to 47,359. I wouldn't do it because the weekly chart is extremely weak for now, and the market as a whole is extremely weak. We're having changes in sentiment here across the board, not just Tesla, by the way. For example, one of the biggest tulip pumpers here, your boy, your favorite analyst from Neptune, Tom Lee. And Tom Lee, if you noticed, magically, his laser beams are gone. He's no longer hodling, hoodling, whatever. His laser beams disappeared, and he says, now that I got verified, I gotta be professional, and I'm taking the laser beams off. Watch out here, watch out. The rats are jumping ships. Moving on to AMC, a very interesting chart here. The chart was down big, and the destination, the target was 32. And I had my bananas ready. No popcorn, bananas. And I was waiting and waiting and waiting for the Planet of the Apes Season 10, the Battle of 32. It didn't happen because for now, we have a pump. Who knows if this is going to be sustainable or not? But here was the pump. Midday, a massive surge higher. And of course, some took the opportunity to dump. And therefore I say, and I'm suspicious here, because somebody bought the 40 bucks calls aggressively before the pump. I saw that live on my screen. The stock pops higher to 41.5. 42 almost, and then it dumps right away. So was this a pump and dump scheme, or was this an algorithmic response to a legitimate piece of news, which will be a catalyst for a build-up on the rally? Again, two different scenarios. Is this pump and dump from one trader, or is this a catalyst which the apes will build on and continue to rally higher? And if they do so, they better close above 42.5 by the end of the week. Absent of that, if we have another dump, forget about it. We're going back to 32, and if 32 is broken, we got a massive problem here. And lastly, somebody asked me about LMT, Lockheed Martin, a stock that I own, and unfortunately, it hasn't been performing pretty good. We have a triangle pattern consolidation here, which was broken to the upside. The problem is it went all the way to the resistance, and it failed to cross above the resistance, and it formed the double top formation, and now it crossed below the trend line once again. It is holding above 339, my line in the sand, and it tried this week to climb higher, to reclimb and regain the trend line, and so far it is failing. So this is not looking good here. My line in the sand is 339. If this is broken, then I'm out. And the reason is I'm holding this as a dividend-paying stock. But what is the point of holding a stock to collect 2 to 3% dividend when your core position is down 10 to 15%? This is what we call a dividend trap. And therefore, 339 is my line in the sand. If it doesn't perform, if it doesn't bounce higher, I'm getting out. We have plenty of other dividend-paying stocks that could perform better than LMT. Lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have a heavy day here in macroeconomics data. We have nominal personal income, nominal consumer spending, and then core inflation, the manufacturing PMI and ISM index. Likewise, we have construction spending, the final consumer sentiment reading, and we have other Fed zombies here speaking from Harker to Mr. And again, I don't see this day, even though it's important from macro perspective, but I don't see this data as market mover. The most important thing here is the sentiment and the momentum. And for now, the bears have the momentum. The sell the rep. Every time, the bears are winning, finally. What am I looking for in tomorrow's activities? The VIX. Will the VIX close above 20? Will it close below 20? Above 20, the bears win. Below 20, bulls win. Likewise, do we have a top in the dollar and yields? We're not going to have a bottom, folks, unless the dollar and yields top together. And with that, ladies and gentlemen, I'm done here. This is all I got for you for now, but I will talk to you again tomorrow.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.